Okay, good afternoon, everyone. Welcome to today's webinar. We are going to get started. Let me introduce our MC for the day, Mark Abrams. He is a partner in our tax practice. Mark, I'll let you get us started.
Thanks, Misty. Really appreciate everyone joining us today. I hope you all are ready for the holidays. We're going to really give you something to think about now as you plan for your year end and think about things moving into 2023. I'm Mark Abrams. I'm a partner in our tax group. Been with the firm for, this is my 25th year. I am a partner in charge of our real estate construction niche group, and I work with a lot of high net worth individuals. For some period of time, I worked with Michael Mueller, who's also on the call, his team at the wealth management group when we started that over 20 years ago as well. Michael is a senior wealth planner, UJ grad, go dogs, and works a lot with our families as a family CFO, trying to help them navigate their discrete and very special needs if they have different questions that come up in the financial planning realm. Cass Pittman is a partner in our tax group and works a lot with our high net worth individual and trust clients, as well as in the manufacturing distribution space. And she's been with the firm for more than a decade. Before we really get into it, there's a couple of housekeeping things I'd like to mention. We do have polling questions. This is CPE, and you are eligible for CPE credit if you answer those 3 questions and complete your surveys, which will be emailed after the event. There is also a Q&A feature. If you do have questions as we go through this presentation, please feel free to ask. Today, we're going to cover an overview of income tax, estate planning, and financial planning, as well as other planning things that a lot of our clients are considering as we approach year end. Without further ado, let's kind of jump in and give me a moment as I control the slides. Smith & Howard is a family of companies that was started in 1970 by Joe and Jim. There's a famous story about a flip of a coin and Joe won. So voila, we are Smith & Howard. Today, we are a firm that's over 160 and growing with professionals in 10 different states. We were recently named Best Workplaces by Atlanta Journal-Constitution for the 13th consecutive year. We're also one of the top firms by Inside Public Accounting for over a decade. We're driven by our core values and started our meetings by reading our client people, excellence, and integrity values. We also have a team that's dedicated to COVID. So if you have special questions regarding employee retention credits, payroll protection loans, shuttered venue operating grants, or any of the other number of CARES Act specific benefits, we have a team of folks that are answering a lot of those questions and adding value for our clients. We're also very committed to proactive communication with our clients and are talking regarding new and upcoming tax law, which brings us to today. Today, we will cover a lot of these things, and primarily it's individual income tax planning for those who are with us with the business tax planning webinar. Some of those concepts are relevant as well, because at the end of the day, the individual or trust is going to pay taxes on a lot of the things that are going through their closely held businesses if they're flow through. Timing, traditional planning involves forward planning or reverse planning, as we talked about last week. Timing of deductions and timing of income are important. We will talk about that. Character of income is important, long-term versus ordinary. There are different taxes that apply to different types of income. There will be some financial planning concepts that we discussed, like long-term care and retirement plans. And for foreign U.S. Citizens working abroad, we'll talk a little bit about foreign considerations and other taxes that affect individuals, including AMT and kiddie tax. There's a limitation on state and local taxes. We're going to talk about the SALT workaround. And finally, charitable giving, estate planning, and some other special considerations on losses. Let's jump in. Today, we live in a world of 7 brackets for all of our individual filing types. We also have, for trust on the far right of this screen, you'll see that there's basically 3 tax brackets, but you get to the top bracket very quickly. As we approach 2023, you will notice that everything that is inflation index is growing by 7 to 11%. Today, taxpayers married filing joint earning over approximately $650,000 of income a year are in the 37% bracket. Next year, that jumps up to 693,000. You can tell that there's a huge effect to inflation. That's going to trickle through on all the other inflation indexed phase outs and other calculations under the code. Forward planning versus reverse planning. There are a number of things that you should think about. If you're expecting your income to be higher in one year or the other, and your rates are going to be higher in one year or the other, you should think about these things. If your income is growing and you expect more income in the future, deferring income may make sense, or accelerating deductions this year, or you could do the flip, the reverse, where you would maybe defer deductions to the next year in order to offset higher expected income. We're looking at a lot of strategies to accelerate income. If you have loss attributes that we can offset, like capital loss carryovers or net operating loss carryovers, and if you need to accelerate income and you started a sale of the company in 2022, and would normally stretch out the gain and tax over time as you receive an installment payment, you can elect out of installment sale treatment to accelerate gain, for example. You might think about deferring deductions. If you expect income to be higher next year, you could lump up your charitable deductions and giving into the following tax period, and vice versa if we're in a high tax year this year. Some other concepts, if you have control, we're getting close to the end of the year, but you still have control over the things that you can sell to a degree. If you haven't set a closing date, you could consider deferring a gain event towards the end of the year. If we're thinking about that, you could defer to next year. It's also true that if you've harvested a bunch of capital losses this year because of the market and things that have occurred, or if you've had other transactions that flow through to you, you could accelerate gains into 2022. So looking at those loss attributes and what's happened year to date, maybe what's coming into this year, are important when you think about when do you trigger gain or defer gain. Delaying interest or dividend payments. Our individuals and trust clients are largely cash basis. When you write the check, determines when you get the deduction or when you pick up the income. So if you have a closely held business, you obviously can control on a taxable corporation the timing of a dividend payment or the timing of an interest payment. You could defer commissions if you are in that type of compensation arrangement system. You got to be careful. You can defer comp, generally speaking, but you would have to do that before the end of the year or beginning of the year in order to avoid certain penalties under 409A of the code. But deferring commissions can be done if the sale hasn't occurred. You can just negotiate with your sellers about the timing of, or the buyers about the timing of when those payments are occurring. A lot of cash basis taxpayers accelerate payments at the end of the year. To a certain degree, you can't control it, but to the extent that you can, this is something that you might consider. You can lump deductions. I said that earlier. If you have higher income, let's pay more charity this year. Go ahead, fill your 5-year commitment now. You could also, as Michael will discuss later, use vehicles like donor advised funds. Interest payments are deductible as paid. That's another thing you can do with your mortgages. If you have gains, but you also have some bad investments and they're worthless, you could consider taking a non-business bad debt loss. Those are short-term in nature. Longer term, if you haven't done it yet, but maybe something to consider for the future, if you are in the highest bracket, muni yields are at around 4% today. You could invest in municipal bonds and change the type of income to tax exempt. And as tax planners, we like things that are permanently never taxable. They create a permanent tax benefit. Be careful. I do think today the after-tax yield of taxable bonds relative to the after-tax yield of muni bonds is comparable. You could consider using municipal bonds in your investment portfolio to minimize income, and you could do that in a way that's tax exempt for Georgia as well, if you're a Georgia taxpayer, for example. Timing of income and deductions. Again, we'll look at accelerating gains and deferring capital losses if necessary, electing out of installment sale. We mentioned this earlier. And then, deferring our deductions to 2023. There is a polling question. So please pay attention. If you're not in front of your computer, please run back right now. Do not trip. We're about to put up a polling question. Who will win the college football playoff championship? Ohio State, TCU, Michigan, or UGA? Survey says UGA. Good choice. Excellent. All right, moving on to gain brackets. We have 3 basic brackets. There's really 5 capital gain brackets, and you can see here again that the brackets are growing 7 to 11%. Something to note in 2026, a lot of these 2017 TCJA bracket structures are going to revert back to the pre TCJA, or so pre-18. If for those that remember, the highest capital gain bracket and the highest ordinary income brackets were linked. They are no longer linked. You can tell these numbers are smaller. You hit the highest capital gain bracket earlier than you do the highest ordinary income bracket, but that is scheduled to revert back to something close to, if you're married filing joint, 450,000 adjusted for inflation. It's important to look at that. Capital losses can offset capital gains, as we discussed earlier. If you have gains and you're looking at trying to minimize those, capital losses, if you have short-term capital gains, can offset the highest rate gain first. Net capital losses, you can only deduct up to $3,000 a year. You can bank losses. If you have a lot of losses and you're expecting a gain event in the future, go ahead and take those and bank them for future use. You could also consider long-term deferral strategies for capital gains, reinvesting gains into something else, like kind exchanges. If you sell real estate, you can buy any other type of real estate if you do it in the right way. There's also opportunity zones. Be careful. There's a lot of timing and different clock rules related to those 2 different types of transactions. But for opportunity zones, you can reinvest just your gain dollars and put your basis dollars back in your pocket and defer the gain and the tax on the gain for a limited amount of time. You will ultimately pay tax on the original gain in 2026, and any future appreciation, as long as you stay in the OZ fund for more than 10 years, would be tax-free. Again, that's a permanent exemption from tax. We like those. We like deferral strategies too. Donating appreciated property is better than giving cash. You don't recognize the gain, you get a full fair value deduction. Finally, investment income is subject to the extra net investment income tax. Interestingly, that top bracket, 200,000 or 250,000, depending on filing status, hasn't been inflation adjusted. So this is hitting more and more people. It's a 3.8% tax on investment income above a certain threshold amount. That is scheduled to stay in place regardless of what happens to the TCJA sunset in 2026. Michael,
Thanks, Mark.
over to you.
Thanks, Mark. I'm going to gain control here. Thanks for kicking us off, and thanks for everyone for attending. I'm going to kick us off by talking about Social Security tax, Medicare, and some long-term care insurance thing when it comes to tax and some planning topics as well. So the Old Age Survivors Disability Insurance, OASDI, is funded through the FICA tax, Federal Insurance Corporations Act tax. If you are self-employed, you're going to pay 12.4%. And if you're a W-2 employer working for an employer, you're going to pay 6.2%. There are wage bases on how much you're going to get taxed. So in 2022, that's $147,000. Because of inflation this year, that's going to go up to $160,000 in 2023. From a planning perspective, a lot of clients are coming to me and asking, hey, should we include Social Security for our income flows when we are, doing retirement projections for the long term? From what I just read from the Social Security Administration website, the Social Security trust fund will be depleted in 2034, but from 2034 and onward, if that is depleted, current income tax paid to the fund will be able to pay out 77% of planned benefits. Now, for someone like me in their 30s or 40s who's not yet, have filed yet for Social Security, I don't know what that means for them in the long term. But if for current filers during that period, they will be able to, on the worst case scenario, get 77% of their planned benefits paid out. Moving on to Medicare. So if you are self-employed, you're going to pay 2.9% on earnings. And if you are a W-2 employee, you're going to pay 1.45%. If the IRS deems you a high earner, as seen below here on the AGI threshold holds below on the page, you're going to pay an additional 0.9% on your wages. Now, Social Security, there's a wage base. When it comes to Medicare, there is no wage base. So you're taxed on all of your earnings. What you're paying into right now is Medicare Part A. That's hospital insurance. So when you go to file for Medicare at age 65, you are paying for Part A, but you also, once you retire, have to pay for Part B, which is medical insurance. And then depending on if you get a supplemental plan or a Medicare Advantage plan, which is Part C, you're going to be paying for premiums for that as well, and prescription drug coverage, which is Part D. Long-term care. This is another big planning opportunity and planning subject that comes up when I'm meeting with clients. You are actually able to deduct some of your premiums if you have purchased a qualified long-term care insurance policy. You can see here, it depends on your age on the left-hand side. You can see the deduction limits for 2022 and 2023 on the right-hand side. A planning tip, in general, the best time to plan and look at purchasing a long-term care policy is going to be in your late 40s and 50s. And that's assuming that you would be able to go through underwriting favorably. You can purchase a traditional long-term care contract, but those are getting more and more expensive these days. A couple planning tips for people who may be looking at these are looking at possibly purchasing what's called a life long-term care policy hybrid policy or an annuity long-term care hybrid policy. Those may have more favorable underwriting provisions, and you can also pay into a life insurance policy. And if you end up not needing the long-term care insurance, you also have some cash value life insurance or an annuity left over. So it's not just paying into something that you might not inevitably use. Retirement plan contributions. So I'm sure many of you are familiar with the 401k or the 403b and traditional IRA and Roth IRA. You can see how much you're able to defer from your salary here. And if you're over age 50, you get an additional $6,000 that you can defer into these plans. When it comes to traditional IRAs and Roth IRAs, there are adjusted gross income limits. So if you're a high earner, most likely you're not going to be able to fund a traditional IRA and take a tax deduction for it. Likewise, with the Roth IRA, you're probably not even going to be able to fund a Roth IRA. So a couple planning tips here. When it comes to 401ks, look to see if your company has a match. If the company is offering some type of match, I always encourage my clients to at least fund up to the company match. If they don't, still, it's a good retirement vehicle. And whether or not you're funding a traditional IRA or a traditional 401k or a Roth, that's going to depend on what tax bracket you're in, or where you think you're going to be in retirement. The rule of thumb here is you want to pay the least amount of tax on this money. So if you think that you're going to be in a lower tax bracket in retirement, it's going to be better to fund a traditional IRA now to get that tax deduction and then pull the money out when you're in retirement at a lower tax bracket. As I was mentioning earlier, go ahead.
That's a good point. I think, the flip side of that is if you're in a lower tax bracket today, for some reason, you could consider Roth conversions, which is another strategy to accelerate income into the current period. That happens a lot post-employment years. After you've accumulated all your retirement savings, you might see your income drop precipitously before you hit your required beginning date and have to take RMDs. You might be able to average your conversion income and a lower rate over time.
Yeah, that's a good point. That's another workaround. Like I was saying earlier, if you're unable to contribute to the Roth IRA and you already have an IRA, or you retired and have a 401k that, maybe you roll into an IRA and you have a low income year, you can accelerate some of that income and you can move it to the Roth and you can pay the tax on a lower amount since you don't have any earned income anymore. Another planning tool is what's called a backdoor Roth conversion. Have some clients do this as well. If they don't have a traditional IRA open or 401k that's been rolled over or outstanding, what you can do is you can open up a traditional IRA and a Roth IRA. Fund the traditional IRA. You won't get a tax deduction. It'll just be after tax. And then you can go ahead and move that into the Roth IRA. It's what's called a backdoor Roth conversion. Now, I have heard some talks in Congress and some proposed legislation that they might be trying to get rid of this, but I haven't seen anything pass currently.
Michael, we have a couple of questions. If you
Yeah.
want to go ahead and answer those before you move on.
Sure.
The first question is, can you use HSA funds to pay for long-term care insurance?
Yes. Yes, you can.
Okay, and the next question is, and you might have just answered this, when retired and doing your RMD, would you benefit from putting those funds into a Roth IRA?
Yeah, I mean, I think it depends. I think it depends on what your tax brackets are, whether or not you need that money currently, or your time horizon on those needs for the money. It's really plan specific and person specific. So it would depend.
Yeah, I will say too that some 401k employer plans will allow for a Roth contribution, meaning you
Yeah.
don't get a deduction to get your wages, and you want to make sure that those accounts within your employer plan are segregated so that when you do roll into an IRA, that you fill up the right buckets, with the traditional taking tax deferred money and the Roth taking the tax exempt money.
Yeah, okay. So this was some biggest legislation that came out in 2019, later 2019, the Secure Act. This did a few things. I'm going to touch on a few of them here. The one cool thing that I actually like is they actually allowed a penalty-free withdrawal from traditional IRAs if you have a qualified expense for the birth of a child or you are adopting a child. That's $5,000 per individual. So if you're filing married, filing jointly, that's going to be $10,000 per couple or a household. What they also did was they got rid of the age limit on contributing to an IRA. So it used to be 70.5 when required minimum distributions were due. What they did was actually raise that to 72, but as long as you have earned income in any given year, you can contribute to a traditional IRA. Now, whether or not you get the tax deduction depends on your adjusted gross income. Again, they did move the RMD age up from 70.5 to 72. So like I was alluding to before, that gives you another 1.5 years to possibly look at doing Roth conversions or some type of tax planning when it comes to moving and filling up different accounts, setting you up for retirement. Now, the first RMD now is due April 1st after the year you turn 72. But one important thing to keep in mind is if you do delay that RMD to the next year of April 1st, you are also beholden to another RMD by 12/31 of that same year. So 9 times out of 10, I tell clients, take the RMD in the year that you turn 72, because otherwise you're going to double up the next year. Now, again, that you might have to talk to your CPA and look at that given tax year. It might be more favorable for you to delay it to the next year, but 9 times out of 10 is usually want to take it in the year you turn 72. Qualified charitable distributions, QCDs. This is a great planning opportunity for people who are charitably inclined and need to satisfy their RMD. So now individuals who are actually 70.5 and older can satisfy their RMD and actually give some of that, all of it, or a portion of it, up to $100,000 to a qualified charity. And you're not going to pay tax on it, and you're also going to satisfy your required minimum distribution. So this also requires some tax planning as well, because you want to make sure that that is more beneficial than maybe gifting appreciated stock like Mark talked about, right, or gifting cash or something like that, which is usually not as more tax efficient. But those are some things you want to consider when looking to do the QCD.
I want to mention one thing here. We do have a Q&A. Misty, get prepared to read that. And when you're thinking about giving or just charity in general, if your only deductions are charity or state and local taxes, you're limited to $10,000, you don't have a mortgage anymore, there's a pretty big gap between your state and local tax and the standard deduction. Most people who give, if they're eligible to do a qualified charitable distribution, in other words, contribute their RMD directly to a charity, can create a deduction that they wouldn't have otherwise because they're losing maybe the first $15,000 of their charity deduction because of the gap between their other deductions and the standard deduction. So this is a powerful tool for a lot of our people who are at this stage where they're in the withdrawal phase of their life and they're past the required beginning date or they're taking RMDs. It's interesting to note, Michael, I don't know if that age 70.5 has changed to match the Secure Act because you really don't get RMDs until you get to 72 now. So as a practical matter, if you're 72 or older, you could do a qualified charitable distribution.
Yeah, from what I've been reading, they did not increase that for some odd reason. But no, that's a very good point on the itemized deductions, taking standard deduction and gifting.
So we have
Okay.
Q&A, Misty, you want to?
Oh, very good.
Yep. So our first question is, if I paid for long-term care several years ago, but never got a deduction, can I take that deduction now?
That's a good point. That's something I do not know. I have to defer to the CPAs on
Yeah.
that.
Cash basis taxpayers deduct things when they pay them. So if you missed it, you can't take that deduction.
Okay, and the next question is, can the 100,000 RMD be given to a private 501c or a public charity?
To my knowledge, it has to be a 501c3 or 3C qualified charity. I'm not sure if it can be a private charity.
Anything under 501c3, we have a team of dedicated nonprofit advisors who can answer that question too. But I think the private foundations might be excluded. You got to be careful with that. Generally, you're talking about the normal, usual list of suspects of 501c3 public charities.
Yeah. So there was, when the Secure Act came out, there was some talks around the provisions that it laid out when it came to being a beneficiary of say, an IRA. So what practitioners thought that the Secure Act meant was if you were, a non-eligible designated beneficiary, which you can see down here at the bottom of the screen, that you were beholden to what's called a 10-year clock. So before the Secure Act, you could stretch those RMDs over your lifetime, but after the Secure Act, it was said that you could only, that you had to empty the account within 10 years. So we weren't happy about it, but we knew we had 10 years to plan around that. So that gave us some wiggle room there. Now, if you are a surviving spouse, minor children, the plan participant, disabled or chronically ill, or beneficiaries who are less than 10 years younger than plan participant, you can still stretch those over your lifetime. Those required minimum distributions. Treasury regulations that came out this year in 2022 that actually addressed some of these issues. And to a lot of our surprise, there was some ambiguity that wasn't really answered that they laid out here. And basically what they said this year was, if you're a non-eligible designated beneficiary, say a mother passes away and gives the IRA to her daughter or son, and she was not taking required minimum distributions at the time of her death, then the beneficiary, the son or the daughter, would be beholden only to the 10-year clock. But if that mother had been taking required minimum distributions, then not only would the beneficiary be subject to the 10-year clock, also annual required minimum distributions on top of that. Now, because the IRS didn't come out until February of 2022 and update this, for practitioners and beneficiaries alike, they did waive the RMD penalty, failure penalty for 2021 and 2022. So going forward in 2023, if you're in one of these scenarios, make sure that you understand the rules, consult with your financial advisor, tax professional, and make sure that you understand these rules, because going forward, if the decedent died while taking required minimum distributions and you're not an eligible designated beneficiary, you will have to empty the account within 10 years, and you will also have to take annual required minimum distributions. And that first RMD is due by 12/31, the year after death. Retirement plan contributions. So small businesses and self-employers, if you're looking to open up a retirement plan, one that's really popular that we see with a lot of our clients is what's called a SEP IRA, simplified employee pension plan. Now you can contribute as a business owner, you can contribute the lesser of 25% of your net salary or the max amounts established by the IRS, which in 2022 is 61,000 and it's going to rise to 66,000 in 2023. Since it's net income, the real calculation comes out to be between 18.5% and 20% of your net income. So you want to be holding to that limit there. And keep in mind too, if you are a small business owner, if you decide, hey, I want to, contribute the max 25% to my account. If you have eligible employees that are also able to participate in this plan, you also have to fund 25% of their salary into their SEP IRA as well.
Yeah.
So it does require some planning, looking at your employees, how much they make, are they eligible to participate or are they not? And then really answer the question there if you want to open up a SEP. One other retirement account that I really like that I pair sometimes with the SEP is what's called a solo 401k. And this is for solo practitioners. And this is just like it sounds, it's a 401k for sole proprietors. You don't have any employees. You're not beholden to the 25% limit there. So you can defer technically up to, 22,500 of your income as a salary deferral. And then you can also make an employer contribution up to the max of 66,000 next year. So it is a powerful tool, and I really like those two retirement accounts, and they're relatively easy to set up as well.
Yeah, there's some planning around if you are self-employed. We do have a polling question coming up, so pay attention. And then there's some other Q&A. Misty will answer that if we have time. But there are other types of plans: cash balance pension, defined benefit plans. If you're a sole proprietor, you could do those things. Keep in mind, if you're setting up retirement plans, there are anti-discrimination rules. Generally speaking, with changes to 401k and things like that, you have to package those or announce those and give notice and so forth prior to some point like the third quarter of the year in order to give people time to assimilate that and avoid anti-discrimination rules. But for other businesses, solo or sole proprietorships, for example, you might be able to still do a defined benefit pension plan or a cash balance pension or some other form of that, which would be on top of or in addition to the max $61,000 amount that you see there for the traditional defined contribution plans. Could be powerful. You do need to get plan documents now. And the other comment about retirement plans before we get to the polling question is, this is one thing a cash basis taxpayer can defer. You have until the extended due date of the return to make these contributions.
All right, polling question coming up. What is a
Yeah, while everyone's answering that, we do have two questions.
Yeah.
If you mix a deduction in the past, can you file an amendment within 3 to 5 years?
Yes, there's a statute of limitations, usually 3 years from the date you filed that earlier return, and you can go back and claim deductions on amended returns.
Okay, the next question. With the confusion with the IRS ruling, read the Secure Act. If a successor beneficiary or a deceased beneficiary who had started receiving the distributions relied on advice that they could wait until year 10, but now realize that they have to take the RMD since they have only 8 years left if they wait until 2023. Are there new tables?
I'm not sure I understand the question.
Yeah, so I think the Secure Act came in. You have to understand when the Secure Act came in, and was there a grandfathering rule for inherited IRAs that were inherited prior to the Secure Act? The old rule was you had, you stepped into your own, life expectancy table that assumes that you're, it's based on your own life expectancy in effect as a beneficiary. The new rules say if you receive an inherited IRA, then you have this 10-year rule, but there's this 2-year period where people were in kind of limbo. So I think the answer is it depends on when you inherited it. Is that right, Michael?
Yeah. If you inherited it before the Secure Act, then you're still able to stretch it over your lifetime. If it was post Secure Act, then you still are beholden to the 10-year clock or and annual RMDs, depending on when the decedent passed and if they're taking RMDs or not. You will still have to empty it. You will still have only 8 years to empty it from the time of going forward, because 2 years already passed.
to those who answered tree nut, congratulations. Well done.
All right, and I think I'm going to pass it on to Cass Pittman.
That
Going
might be
forward.
me again. So I'm going to pick up here. We'll hit a little bit of the, the other stuff. Earned income exclusion. If you're working abroad, those are also increasing. You can have up to $112,000 of foreign earned income, and it's totally excluded from the U.S. tax system. If you have more than that, then you pay tax on the difference. For other types of income that aren't earned, like interest dividends, you still pay tax on that in the United States. If you happen to earn things abroad, there's a foreign tax credit mechanism that would eliminate double tax. The main thing that we think about when we're thinking about cross-jurisdictional planning is try to avoid double taxation. And there's a number of ways to do that, whether it's a deduction or a credit. This is traditional planning for those working abroad. Alternative minimum tax doesn't apply to C corps, but it applies to individuals and trusts. So if you're receiving income from a business that's flowing through to you, you may have a number of things that affect this calculation. And oddly enough, if all you have is wage income, it's still possible, even though we don't have a 2% miscellaneous itemized deduction or state and local tax deduction above a certain amount that used to be traditional triggers for AMT, it's still possible to get trapped with a little bit of AMT, but most of the things that cause it would be timing differences between AMT methods and regular tax methods that we calculate on our flow through businesses nowadays. Cass, I will turn it over to you.
Thanks, Mark, and thanks, Michael, for all those planning ideas. So I just wanted to touch on a few more areas of the tax law that individuals might see affecting their returns in 2022. So kiddie tax, this is not a new tax. This has actually been around since the Reform Act of 1986. So this has been around a while. The limitation changes, but this tax is designed to eliminate the benefit of transferring assets to dependents and using up their lower brackets. The way it works is if you have a dependent on your return that's under 18 or is a full-time student and under 24, and they have investment income that's above $2,300 for the current tax year, then they will either need to file a separate return or be taxed on the parent taxpayer return at the parent's rate. So depending on how much their total unearned income is will determine whether they have to actually file a separate return or if they can be included. There's a form 8615 that can be included on the parent's return to tax that income at the parent's marginal rate and eliminate the child having to file a separate return. See if I can move this forward. So not as old as the kiddie tax. This was introduced in 2018 under the TCJA, and this is a state and local tax limitation. So you've likely heard about this for itemized taxpayers. The state tax deduction is limited to a maximum of $10,000 for married filing jointly for the combination of your real estate taxes paid and your state income taxes paid. So this sunsets after 2025. So starting again in 2026, if there's no changes or new tax reform, this will sunset and state income taxes and real estate taxes will be allowed to be deducted as an itemized deduction with no cap. But until then, they're still limited to $10,000. And where we saw this affecting taxpayers the most was for our pass-through business owners. And pass-through business owners are taxed on or pay the federal and state income tax of their company's income at the individual level. So when this threshold came through, all of those state taxes for that company income was then the expense was limited and no longer allowed to be taken at that individual level. So starting in 2021 and enacting also in 2022, some states are allowing the companies, any pass-through entity, to make an election in order to pay those state income taxes on behalf of the owners at the entity level. What this does is this actually puts a deduction on the federal return for those owners and allows them to take that state expense So it's no longer being capped at the $10,000. So you'll hear about a SALT workaround, and this is what that is. All of the states are different, of course. There's about 35 states that are participating right now, and they have enacted different ways to make this election. So Georgia started allowing the election in 2022. So this is the first year our Georgia residents can use this for Georgia source income. But it is something that's at the company level, and there's definitely complexity since there are so many differences to make sure it is beneficial, but something definitely to look at if you're a company owner.
Looks like we do have a question in the poll.
The first question is, any current proposal to increase state and local tax?
So right now it's at the $10,000. I think you're referring to the limitation. As it stands right now, without any tax reform changes, it will stay at 10,000 until 2026, and in which case that limitation is gone.
I will also add, there is a year-end budget reconciliation wrangling process that's going on right now. We don't know what that looks like. There could be some changes. I do know initially when this came out, prior to the 30 states that Kaz mentioned coming up with a workaround, states like New York, California, New Jersey that have high rates, those legislators were up in arms and they were pushing for a higher cap. That was in a version of the Build Back Better. It has not been really mentioned since then after that bill failed to pass.
Okay, and the second question, are real estate taxes deductible on a non-income producing second home?
Yes, they are. So once again, though, they would be combined into that aggregate number in that $10,000 cap. So they would be a deductible expense, and then you just have to see if you're over that $10,000 cap or not.
We also have a guest that has their hand raised, so I want to see if I can let them talk. Mark, you should be able to ask a question now if you would like.
It's on
You
mute.
may be a mute.
Maybe. have to
And maybe
type
he
that.
didn't mean to raise his hand. Okay.
Welcome to the call, Mark. Thank you for
Mhm.
your participation.
So I'll
Okay.
move on since I know
Yes.
we're getting close on time here, and we want to be careful with that. So charitable contributions, this is definitely a familiar deduction for most of our taxpayers. So in the past, your charitable contributions were limited to 50% of your adjusted gross income. With the CARES Act over the past couple years, we had the opportunity to actually make take charitable contributions up to 100% of your adjusted gross income to certain charitable organizations, so your public charities. So coming into 2022, 2023, we don't quite have that great 100%, but we're not all the way down to 50%. So individuals can contribute up to 60% of their adjusted gross income to offset that income. Something to keep in mind, and this is not new, but your contributions to non-operating private foundations, those generally have different adjusted gross income thresholds. So that's still the 30%. So that's not new, but just to be aware of that. And then there's always planning also around your charitable contributions. And some techniques like using a donor advised fund or a charitable remainder fund, or even a private foundation can allow you to match the timing of your deduction with income events. So similar to how Mark had referenced this earlier, you can use a donor advised fund to bunch contributions that you may make over several years, maybe put a few years into 1 year that you have a large income event. And then that donor advised fund will then be directed by, your wishes on how you want to allocate that out to organizations. And that can go out over several years. So you get the charitable deduction in that first year where you can control that and then can allocate in saying that maybe you don't want organizations to have it all up front, or you're still waiting to see which organizations you want to give to. It gives you that flexibility to then dole that out in later years. And then something that we always mention is if you have appreciated property, that's definitely a preferred way to donate to a charity, because you get the fair market value of that property as a deduction on your individual return, and you're not having to pick up any capital gains for that appreciation that that asset has had over the years.
Yeah, Cass, I'll add here too, just something to think about, we might see more of. As in interest rates rise in a rising environment like we are in, charitable remainder trust could be an excellent strategy too. If you're a taxpayer that has a highly concentrated stock position, you could sell that position and diversify it and then stretch the gain out over the life of a charitable remainder unit trust or a CRAT structure. And you, with higher interest rates, you get a bigger present value or charitable income tax deduction of that remainder interest that will eventually go to charity. So it's something to think about. If you're in that situation, you need to diversify, stretch the gain out, stay under the highest capital gain brackets and net investment income tax brackets, and ultimately get a deduction to charity in a high income year.
Absolutely, absolutely. So just a heads up on this slide, we do have a poll question coming at the end in case you need to activate your screen in order to answer that and get credit. But just wanted to cover just high level some estate and gift tax changes and planning ideas, some things to consider out there. So kind of your basics, the annual exclusion for this year has increased to $16,000. It's been $14,000 for a long time. The annual gift tax exclusion and the unified estate exemption and gift tax exemption are all inflation adjusted. So with our large inflation jump, we're also seeing changes in these as well. So for 2022, your annual exclusion is $16,000. That jumps to $17,000 next year. And then right now, the estate and gifting exemption is around $12 million per person, so about $24 million per couple. And that's going to raise to just under $13 million per person for 2023. Something to keep in mind, these are the limits right now. Our crystal ball is never clear with this, but we do know if there are no changes to tax law that comes out before 2026, that this is going to be coming back down. It's going back down to 5 million, which will be over 6 million, probably inflation adjusted, but something to keep in mind that there is an expectation that this will come down. So thinking about your gifting and gifting now, and we'll touch on this a little bit later in the next slide, but just thinking about where these ranges are going to be coming in. As always, any gifts to a spouse are tax-free. That as long as your spouse, you're both U.S. citizens, gifts between each other are tax-free. If you have a non-U.S. citizen spouse, the first $164,000 is a tax-free gift, and then after that, it would use up your go the normal way of any other gifts. That goes up to $175,000 for next year. And so now we have a polling question, if we want to get that in. Okay, polling question. How many Hallmark movies does your household watch during the holidays? We have 0, 5, 10, and stopped counting as our options.
And Cass, while they're answering that, we do have one other question in the Q&A. And after this one, we'll hold all the other questions till the end. This question says, can you please confirm that the AMT tax doesn't apply to C Corp?
I confirm that. I can confirm that. Permanently repealed by the TCJA. Note AMT after 2017.
And it looks like our winner is 0. But there we
Zero.
go.
They're just watching Netflix.
So continuing on with this estate and gifts. So a gifting strategy that is there is to consider what's not considered a gift. So payments that are made directly to medical providers or to educational institutions for individuals are not included in your gifting amount. So if you're helping pay for a grandchild's school, instead of paying, a cash gift to the parents, which then would use up either your annual exclusion or work into your lifetime exclusion, you can pay that directly to the school And if you're paying that tuition directly to the school, it is not considered a gift. So talking about some basic strategies when thinking about gifting and moving assets out of your estate, really looking at the first one's the easy one, making use of your annual exclusion. So thinking about the limitation right now being $16,000 per person. So if you have one individual giving to a family of 4, that would be $64,000 that they can move out of their estate. If you're a married couple, and so as a joint group, you are making a gift to a family of 4, then you'd double that and you'd have $128,000 that you've moved effectively, out of your estate to another generation or another, well, really just out of your estate to another person. So looking at that, and if you're using that strategy over several years, that could really build up. And then also looking at if you're making larger gifts, making those of appreciated property, either directly to individuals or through a trust. And so when thinking about those gifts that you're making, really looking at what assets you have that are appreciated assets or appreciating assets, since then you'll not only be moving the asset out of your estate, you'll be moving all that future appreciation out as well.
And I'll mention before we get to the Q&A,
Yeah.
pay attention to the exemption. It's also true that, even though you can't predict your data demise, if you're shifting basis, you will get a basis step up at death. So you have to be careful to both pay attention to staying under the exemption amount and maybe shifting the right assets to these types of trusts so that the appreciation on these assets escapes estate taxation in the future. But it is a carryover basis gift. If you're giving during life, that basis doesn't get stepped up. So you may be in the middle somewhere where you're not over a combined $20 million estate, or 20, it's going to be, I guess, close to $22-23 million estate today, 26 next year, husband and spouse. And your estate's well below that, or it's well below the sunset version, which might be 12 million combined. Gifting during life may not make as much sense. So you need to discuss that with your advisors to make sure that you're utilizing those strategies effectively.
Definitely. And all of these are very unique to everyone's individual circumstances. So definitely not one size fits all, which also goes to this last note on this slide, mentioning different trust setups that are available. So these are some more, maybe more complex structure planning, but that would allow individuals to move assets out of their estate, but would still or could still be set up where the individual is paying the tax on the income of those assets, even though it's out of their estate. And so in essence, an individual is making a gift, a tax-free gift of that tax, while those assets grow in a trust that's separate from their estate. So lastly, and we're getting close on time, so we're just going to jump through this quickly. We just wanted to touch on net operating losses and the limitations here. So in 2022, if for business owners out there that have pass-through entities, there's the limitation on the usage of NOLs that were created in 2018 forward is limited to 80% of the current year income. So that's just to keep in mind. If you have NOLs that are sitting out there that you're going to be using in future years, those can't be used to bring down income to 0. They can bring down your income to 80%. And then anything extra is not lost. It's just carried forward to future years where you can use it. Along the same lines, individuals that have net business losses coming through to their individual returns, those can be used, the net business losses can be used or applied to the current year return up to $540,000, married filing jointly in 2022. So that would be the max that you could use against other types of income, so investment income out there. Anything over that amount, those losses would be carried forwards and would be treated the same as an NOL. So they kind of move into that bucket. So these are just things to keep in mind as you go through 2022. I know we've covered a lot, and I will send this back to Mark to close us out.
Yeah, I think thank you, both of you. That was excellent. I encourage anybody who has questions to please submit those now. Really interested in what Mark had to say earlier. If he has a good question, let's answer it.
And otherwise, we could give you back 5 minutes of your
Yeah.
day.
We could definitely do that. I'll
Well,
mention.
we have one that just came through.
Good, excellent.
Okay, in the final year of a C corporation, can the unused loss from post 2018 years be used in full?
There's not a, there's still a limitation on taxable income. It's not like a passive loss where you get to use all of it in the year of disposition. But, interestingly, this is not the answer to your question. If you do have passive losses, one way to accelerate losses, if you are, if you have a lot of ordinary income and you have a passive loss activity, you could dispose of the activity, sell it, or otherwise dispose of that activity if it's worthless to trigger that loss and offset other ordinary income. And the previous slide we talked about NOLs, which have an 80% limitation. Those passive losses carry over and then get funneled into your income. They're not subject to that 80% limitation. But it's also true that if you're a taxpayer sitting in that scenario where you have a lot of loss attributes that you can use that have carried forward. Remember, we were talking about acceleration of income tactics earlier, distributing IRA funds if you're over 59 and a half and it's not going to be subject to penalty and you can accelerate the timing of the distribution. That would be a good year to do it, perhaps, if you can use some of the NOL to offset it and stay in a low tax bracket. Those are examples that we would consider in trying to manage your income exposure during your life. Other questions? Well, we are right at time. I think we can give you 3 to 4 minutes back of your day. You will still get a full hour of CPE credit. If you want it, please fill out the survey. Don't forget to do that. We really thank you for your participation and joining us today. We look forward to speaking with you about your tax planning needs in the future. Without further ado, thank you to Misty, Nancy, Grace, and everyone who participated in developing the slide deck. We couldn't do it without you. This went off without a hitch. Thank you to the participants who joined. We look forward to talking to you in the future.
Thank you.
Bye-bye.